Let's focus on JK Cement. That's the next corporate on our show. The quarter three numbers look very, very good. Sales volumes as well did surge up. And they've also announced capacity expansion. Mr. Anuj Khandelwal, the business head, joins us on the show. Hi, Anuj. Good morning. Thanks so much for joining in. Well, tell us, how is demand on ground? If you could tell us ahead of election, how do you normally see? Do you see things slow down a little bit? Is construction activity as good as expected? And what does that mean in volume targets for this year as well as next year?
Hi, Nigel. Firstly, thanks for having me on this segment. And yes, look, the demand for the full year per se till now has been really great for the industry, right? The overall industry has grown at double digits. But in Q4, we are seeing slight slowdown from the lofty levels we've seen earlier this year. So we'll still, expect the industry to grow around 5% or so in Q4. Q3 was also in the similar levels. What we believe is maybe in the second part of the next financial year, we'll again see huge growth coming back after the electoral activities have concluded. But overall, still, I would say from an overall year perspective, it's quite a fantastic year from a cement demand outlook.
Okay, all right. And for this year, the volumes that you are targeting, I think grey cement was around 16.5 million tons. And overall cement, you were looking at around 18.5 million tons. Is that a fair estimate?
Yes, that's right. So on grey cement perspective, we are targeting around, let's say, near 16.5 million tons as we had guided. And overall, on a consolidated volumes basis, we'll end up somewhere around 18.5 to 19 million, which will still be, let's say, a good 16-17% growth versus the previous financial year.
The problem is the challenge is on a high base, how much can you grow? So if you're expecting the second half of the year to look good, then what kind of a growth can you expect on this high base? Point number one on volumes. And the EBITDA per ton, what is the outlook on that front as well from year on? I recall when you joined us last in November, you were saying the second half of the year will be much better. And your past quarter actually was very good. So what is the rough range we should work with?
Okay, so let me first take up your point on the volumes. Yes, of course, we have had good volume growth over the last 3 to 4 years, but we are confident of a good volume growth in FY24, FY25 also, which is the next financial year, because we have also new capacities coming up in Prayagraj, and the capacity which has just got commissioned, Ujjain, will also, give us more volume leverage. So overall, we still believe that, maybe we'll be able to clock a healthy volume growth next year in spite of a relatively slow start to the market in the first half of the next year. So maybe around 8 to 10% growth, we'll definitely, try to target. As far as volume, as far as EBITDA goes, yes, last quarter was really good. Overall, look, we had a target of 1,000 rupee per ton on a consolidated basis for this year. On a YTD basis, we are running at 1,080 rupee per ton or so. So we are, targeting to end the full financial year FY24 around that levels, 1,080 to 1,090 rupee per ton, which will still be a good 90 to 100 rupee per ton greater than what we had internally targeted.
Okay, that's good to know on the EBITDA per ton. What about, the volumes on the premium sales? What would that number stand at for this year and even for next year as you look to target an 8-10% kind of a volume growth?
Yeah, so premium sales, as I had covered in the last segment also, we are right now at 12% of sales. That's how our premium sales is. We are taking very conscious steps on, how to increase premium product. Next year, we'll be targeting to touch 14-15% on premium sales.
Also, since we're on the topic of, volume growth, I want to touch upon your capex plans. You've laid out a strategy to hit 30 million tons, I think by 2030. Will you look at an acquisition
20?
in the... You want to hit 30 million tons by 2030, right? That's your capex plan.
No, that's not right. Look, we are at 22.2 million right now, with 2 more million tons in Prayagraj coming up by July. So it'll be 24 million by June 24. And by March 2026, we'll touch 30 million. Because with the expansions which have been approved by the board, and assuming the construction time which will take to make those expansions live, we'll touch 30 million by March 26.
by March 26. And so there is no acquisition plan for the next 2 to 3 years.
So look, our base plans are always organic growth, because you really can't plan for an inorganic opportunity. They come when they come. However, if there are some opportunistic, if there are some opportunities which come by our way, we continuously do evaluate. But our base plans are always through organic growth.
I know the couple of plants that are on the block, Anuj, which I can't, name them. And I think y'all as well, being a large player, would be aware of them. Couple of big players on the West Coast. In the South, there are quite a couple of players as well that could be looking at selling out. If you'll have to go for inorganic growth, let's just assume that, hypothetically, what would you all be willing to pay for that?
It's a very, I would say, hypothetical question. It's a lot of conjectures are there, so I would not hazard a guess. But yes, look, opportunities, valuation of an opportunity depends on a lot of things: the existing capacities, the potential to expand, etc. So it's very difficult to put a dollar per ton number to an opportunity. But as I said, we firmly believe our base growth plans are organic growth. So inorganic growths are, once if some opportunity comes up, we'll have a look, but that's not what our main focus is.
Interesting. You're setting up capacity at $60, $70, $60, $65 per ton.
Exactly.
That's why I just thought that if you have to go and pay, I don't know whether you'll be willing to pay more than that.
No, look, conceptually speaking, inorganic growth opportunities gives you faster time to market as well. So,
Yes.
of course, there's a bit of premium to that. But, you are absolutely right that our greenfield or brownfield expansions happen at a much lesser rate, the rates which you kind of mentioned. And we have a good track record of evacuating the capacity fast. So we believe in our ability to evacuate the opportunities fast, and hence shrink the time to market, which takes place when you go for an organic opportunity.
Got it. Anuj, let's add some color to this interview then. The paint segment, that's a very small part of your business, but you're optimistic on the prospects. I think for this year so far, you've done around 120 crores and it's still loss making. By FY25, say towards this second half, do you see this business turn around? Point number one, will it be profitable? And second part is, on the top line, what kind of a number can we look at? I assume this year you end at around 150 crores or maybe a little bit more than that. What do you end next year with?
So Nigel, I don't look at the paints business per se, but maybe I can still throw color, as you said. This year has been a fantastic start. As you said, we've crossed triple-digit mark, and more importantly, there is a good acceptance from the channel and customers in the geographies which we sell. I won't say that we'll in a way turn around the business, because the business is so nascent that it's the losses which you in a way mentioned are some startup costs. It's not essentially that the operations are not doing well. It's just the amount of investment which you need when you start a business. So, but maybe in maybe 18 to 24 months, we'll start getting to EBITDA positive there. But more importantly, right now we want to grow the business, because the business right now, it's just started. We've made first few strides there. So our main focus is to first grow the business and then look at profitability there. But I would still want to say that we've committed in a way an investment number, including loss funding, to the board and the investors. We are sticking with that. We are very disciplined about it.
Okay, but right now the focus is on growth and not profitability. That can be on hold for the next 18 to 20 months. Just one final question, since we spoke about capex, what would your peak debt number be? Are you looking to raise some more debt, and how will you fund that capex? Is there any fundraise on the horizon?
Oh yes, it is, because look, we are doing with the approvals for 6 million ton expansion, which came up in the later part of January, which is last month. We will spend around 2,800 to 2,850 crores on the expansion. So out of which somewhere around 1,000 odd crores will come from internal accruals and 1,850 crores will come from debt over a 2-year period. The way we look at it is that we want to maintain a healthy net debt to EBITDA ratio, which is around 2, because that balances the need for growth while keeping the financial discipline in place. As of December, the net debt to EBITDA ratio for our company is 1.64. So we are well within the thresholds which we've kind of kept for ourselves, and we are at a comfortable level. So that ratio, in we would want to keep it below 2 even when we take up this debt.
All right, we'll leave it there. Thank you very much for joining us, and it's a pleasure having you with us here, sir, on CNBC TV18. Appreciate it. Well, that is J.K. Cement with commentary on the business. We'll